Hi everyone, welcome to another video. Today we are going to talk about accounting for trade receivables. And firstly, we need to understand what is the difference between trade receivables and non-trade receivables. The trade receivables are amounts owed to an entity by its customer, resulting from the credit sale in the ordinary course of business. For example, if you are selling product on credit in your routine business, those customers will stand as a receivable in your books of accounts. All other receivables are called non-trade receivables. For example, non-trade receivables might include for a normal business, maybe lease receivables, maybe tax refunds, maybe insurance claim receivables are loan receivable. Sometime your company might give loan to directors, employees, so those director and employees also, they are also the receivables for you, but those are non-trade receivables because it is not your normal course of business. So you should remember there is a one important note: receivables should be separated into current and non-current portion. Those now we need to understand which receivables are current and which are non-current. So current receivables are classified as current if they are expected to be collected within 1 year or the entity's normal operating cycle, whichever is longer. Actually, this definition is from is in accordance with the US GAAP. US GAAP states that you have to select the longer period, the period of 1 year, and the operating cycle, and then you have to match each assets with the longer period. If that asset, like as we are talking about here regarding receivables, if those receivables will be realized within the longer period, that is called current. If those receivables will be realized beyond the longer period, that is classified as non-current. But under IFRS, so all those receivables are current if they are expected to be collected within 1 year from the reporting date. Now here you have a important note. You can see here, note: current account receivables are reported in balance sheet at net realizable value. Now the question is that what is the net realizable value? So the net realizable value means that you have to take receivable minus allowances for credit losses, maybe uncollectible accounts, or allowances for sales return or billing adjustment. But this is not our topic today. Our topic is we are gonna to talk about allowances for uncollectible accounts. So that is why I will talk more specifically related to allowances. So this is how you will record your receivables in the balance sheet. As I told you, receivables should be recorded at net realizable value, and NRV is equal to gross account receivables. Let's assume it is $100 less allowances for uncollectible accounts, which is $20. So you will get NRV of account receivable, which is $80. Now the question is that what is the gross account receivables and what is the allowances for uncollectible accounts? So you can see here it is mentioned note 1. So let me explain first what is the allowances for uncollectible accounts. So you should remember here. So moving to the note 1, so allowances for uncollectible accounts and bad debts expense. This is really important. This is our topic for today video. So what is the allowance? Actually, it is sometime, it is not possible that you will recover 100% amount from the receivables. Okay, so this is what we are going to talk about. Collection in full of all account receivables is unlikely. Of course, it is not possible that you will recover 100% amount. So allowance for uncollectible account must be recognized. So you have to remember different nodes here. Allowance, you can say it's like a provision. Okay, so this method attempts to match bad debts expense with the related revenue. I mean, it's a matching principle. Okay, because as per matching principle, what we need to do, we need to record all the relevant expenses related to the revenue in the same period. So if you will use the allowance method, I will tell you how to calculate. But if you will use the allowance method, so this method actually is in accordance with the matching principle. Second point, the allowance for uncollectible account is the contra account to the account receivables. Why it is contra? Because in the balance sheet you will take the gross account receivables minus allowances for uncollectible account, because you need to deduct from the gross. That is why it is a contra account. Third point which you should remember, what is the issue with the allowance method, which we are going to talk about. The issue is that the principal measurement issue for the account receivable is the estimation of NRV, because when we will calculate the allowance for receivables, so it is our estimate. So that is why this is the principal issue. Sometimes we might overestimate or underestimate. So here we go, because we need to understand the allowance. So to deal with the allowances, actually guys, we have two methods to measure the bad debts expense and allowance for uncollectible accounts. So first method is called income statement approach, and second method is called balance sheet approach. Okay, and we have the third method, which is called direct write-off method, that I will cover in another video. So here, if you are using income statement approach, so what we will do here, we will calculate the allowance as a percentage of sale, because sale is related to the income statement. So if you estimate like 1% or 2% of credit sale is uncollectible, so it means it's a income statement approach, and we will talk about how to deal with it. So second, we have a second approach, we have a balance sheet approach. If examiner told you, for example, if examiner tells you that like X percentage of receivable, because receivable is the balance sheet item. If any X percentage of receivable is uncollectible, it means it is a balance sheet approach, and you have to tackle the question accordingly. So let's begin with the income statement approach, and we will understand with the help of example. Income statement approach, we will calculate the bad debts expense as a percentage of credit sale reported on the income statement. So how? Let's have a look with the help of example. So here we have example: a company's year end unadjusted trial balance report the following amounts. We have a gross receivables, which is 100,000. The receivables always have a, not always, like mostly have a debit balance. You have a credit sales, which has credit balance of $250,000. You have a opening balance of allowance. This is the opening balance, okay, is the $1,000, and it is a credit balance, okay, because it's a contra account to the receivable. According to the past experience, the company's maybe management has determined that 1% of credit sale is uncollectible. So it means it's a 1% of credit sale. So for sure it is income statement approach, because credit sale is the income statement item. Because sometime maybe examiner will not tell you it is balance sheet approach or income statement. So you have to determine by reading the question data. So as this percentage is applicable on credit sale, so it means it's an income statement approach. So now how we will solve the scenario? So here is the solution, don't forget. So first of all, what we will do, we have to calculate the allowance for the period. Allowance for the period, so which is equal to 1% of the credit sale. And in the question, credit sale is giving $250,000. If you will take the 1% of that, so this will give you $2,500. And don't forget, this is the allowance for the period. Why for the period? Because credit sale is for the current period. So that is why this allowance will be for the period. Now here, when you want to record the entry of the bad debt expense, so here you need to take care about this point. So what we will do, entry with the full amount of allowance, but for the period, like we need to pass the double entry with the amount of allowance for the period. And for the period, allowance is 2,500, we have calculated above. So what entry you will pass? You will pass this entry: debit will go to bad debts expense 2,500, and credit will go to allowance for uncollectible account. Don't forget, this debit side will be recorded as expense in the income statement, but this credit side will be transferred to the allowance for uncollectible account. Okay, so now what we need to do, so now we will calculate the closing allowance. Because in balance sheet, when you want to calculate the net realizable value of receivable, you have to subtract the closing allowance. So closing allowance is always equal to opening allowance plus allowance for the period. So opening allowance was given in the question as 1000 credit balance, and allowance for the period is 2500, which you have calculated above, you can see here. So if you will take opening plus allowance for the period, this will be equal to closing allowance. Now the question is that how we will present this information into the financial statement. So here we go. In income statement, what we will write, we will write the bad debts expense as 2500. But in balance sheet, for the balance sheet presentation, you have to record the receivables at net realizable value, which is equal to gross receivables minus allowances for uncollectible account, which is closing balance. You will always subtract your closing balance. So gross was 100,000 and closing balance of allowance was 3,500. So this is how you will get an RV of receivable, which is 96,500. Now we are going to work with the balance sheet approach. So under the balance sheet approach, what we will do is we will calculate the bad debt expense as a percentage of ending balance of gross receivable. Okay, so for example, a company's year end unadjusted trial balance reports the following amounts. Let's assume you have gross receivables of 100,000, you have a credit sale of 250,000, you have an opening balance of allowance 100,000, and here according to the past experience, 5% of account receivables are determined to be uncollectible. So here you can notice it is 5% of account receivable. So it means it's a balance sheet approach. Now how you will solve it? So first of all, very first thing, what we need to do is we need to calculate the allowance. Okay, but it will not give you allowance for the period. This will give you allowance as a closing balance, because you are going to apply the 5% of receivables, and receivable is your closing balance in the balance sheet. Okay, or in the trial balance. So what you will do here, so if you will take 5% times 100,000, because receivable is $100,000, so it will give you $5,000, which is the closing balance of the allowance, closing. But don't forget, when you want to pass the double entry you will pass for the allowance for the period amount only. Okay, the amount of the allowance for the period only. So that is why you have to calculate first allowance for the period. If you remember, I told you above, the equation for closing allowance, it is always equal to opening allowance plus allowance for the period. Okay, but here I want allowance for the period because closing I already have, which this will be subtracted from the balance sheet. Okay, but to pass the entry I need allowance for the period. So what I will do, I need to reverse this equation now. So I want to calculate allowance for the period, which will be equal to closing allowance minus opening allowance. Okay, and closing allowance is $5,000, which we have calculated here, you can see, minus opening allowance is given in the trial balance, which is 1,000. So this will give you allowance for the period, which is 4,000. With this 4,000 you will pass the entry to record the bad debt expense. So here what the entry you will pass, you will pass the same entry. Okay, the bad debts expense debit, and credit goes to allowance for uncollectible account with the $4,000. Okay, and what this debit side will be recorded as expense in the income statement, this 4,000, and this credit 4,000 will be transferred to the allowance for the period. Okay, sorry, it will be transferred to allowance for the uncollectible accounts. Okay, and don't forget, when we will calculate the NRV, there we need to subtract closing balance of the allowance. Okay, and which was 5,000 above we have calculated. Okay, this 5,000. Now now we are going to talk about the presentation. Okay, how you will present in the income statement and balance sheet. So in income statement, what we will record, we will record bad debt expense as a 4,000 for the period. Okay. And for under the balance sheet, what we will do, we need to write gross receivable, which was $100,000 minus closing balance of allowances for uncollectible, which is 5,000. Okay. So this is how you will get the NRV 95,000. Here now we are going to talk about a balance sheet approach with aging schedule. Okay, sometime an entity using the balance sheet approach generally prepares an aging schedule for the account receivables. Aging mean to say, like, maybe we will prepare how we will prepare the schedule how old they are. So let's have a look here. We have a small example how we can apply the balance sheet approach with the aging schedule. So for example, here you have a aging intervals. You can see here the cursor. So here we have a maybe four intervals. We have a less than 30 days receivables. Like these are those receivables which are less than 30 days older. Then you have our receivables between 30 to 60 days. Then you have our receivables between 61 to 90 days. And then you have our receivables over 90 days. Okay. So these are the balances. Less than 30 days have $70,000. 3 to 60 days have $18,000. 61 to 90 days is $10,000, and over 90 days is $2,000. This is how total receivable is 100,000. Now here estimated uncollectible percentage. Now here each aging interval have separate percentage for uncollectability. Okay, so for example here less than 30 days have 2%, 60 to 30 days have 5% uncollectible percentage, 61 to 90 days it has 13%, over 90 days it has 20%. So once you will take 70,000 time 2%, you will get ending allowance, because it's a balance sheet approach, 1,400. If you will take 18,000 time 5%, it will give you 900 as an ending allowance. If you will take 10,000 time 13%, it will give you 1,300 as an ending allowance. If you will take 2,000 time 20%, it will give you $400 as the ending allowance. Just make the summation, like 1,400 plus 900 plus 1,300 plus 400. So this is a dollar 4,000 total ending allowance. And now guys, as I told you, if you want to pass the double entry, for that you need to calculate the allowance for the period, which is the difference between ending allowance and opening allowance. Okay, so if you remember in the question, opening allowance was 1,000 and ending allowance is 4,000, so difference is 3,000. Now with the difference you will pass this entry: bad debt expense 3,000 debit, and allowances for uncollectible account 3,000 credit. Okay, in balance sheet, when you want to determine the NRV, so what you need to write, you need to write their gross receivables. Okay, which was for example 1,000, 100,000, sorry. From here you will subtract less. What you will subtract, guys? You will subtract here allowances, which, but we need to subtract closing balance, which is here 4,000. This is how it will give you, guys. It will give you 96,000 as a NRV for the balance sheet presentation. Okay, I hope guys this balance sheet approach with aging schedule is clear. Now I'm going to move forward, so let's have a look. So here because this topic, to solve the questions related to this topic, you also need to be aware with the additional entries. Okay, so for example, those additional entries which are relevant to the receivable. For example, we have almost 6 to 7 entries here. At the time of credit sale, usually what entry we pass, guys? We record debit receivables account and credit sales account. And at the time of sales return, what entry we might pass? I'm assuming here you are not creating any allowance for the sales return. So what entry you will pass? You will pass debit sales return account, credit receivable account. And at the time of collection from receivables, what entry we record? We need to debit cash, credit receivable. Okay, and at the time of creation of allowance for the period, when you record the bad debt expense, what entry you pass? You passed debit bad debts expense. credit allowance of uncollectible account. And this entry we studied under income statement approach and under balance sheet approach. Here guys, this is really important point to solve the theoretical questions also. At the time of write off bad debts, write off mean to say when it is sure that you are not gonna to collect certain invoices. Maybe customers got bankrupt, maybe he left the country, okay, maybe he is dead, I'm just assuming, god forbid. Okay, so at that time what you need to do, you need to write off the bad debts, you need to write off the receivables from the balance sheet. And when you want to write off the bad debts, what entry you will pass? Guys, you will pass debit allowance of uncollectible account, because you have already created the allowance. Now just you need to make it debit, okay, and credit will go to receivable account. Here you need to remember, examiner can ask you few questions. Number one question, they might ask you at the time of write off the bad debts, is there any impact on the profit? So you should remember these three. Note, write off of a particular bad debts has no effect on expense. You can see there is no debit expense or credit expense. So that is why at the time of write off it is not gonna to affect the expense or income. Second note you should also remember, second note is what? Write off do not affect the carrying amount of net receivables, because reduction of gross receivables and allowances are the same. Yes, because it will not affect the carrying amount. The reason is that you also reduce the allowance with the same amount, and you also going to reduce the receivables with the same amount. So it will not affect the carrying value, I mean to say net realizable value of receivable. Note 3, this write off bad debts will also not affect the working capital, because working capital is equal to current assets minus current liabilities. Okay, you can say, so it is not gonna to affect the working capital, because your receivable is reduced with the same value, and on the liability side maybe your allowance is also gonna to reduce with the same value. So that is, it's not gonna to affect working capital. The next point you should remember also, sometime this is also really important case. Sometime maybe you have write off certain bad debts previously. You have written off certain bad debts. Now maybe those bad debts is going to be recovered. So at the time of recovery of bad debts previously written off, what entries you will pass, guys? So there are two ways. The first way is what? When you are going to recover, first scenario is this, like reverse the previous write off entry. Previously you have made this entry, debit allowance credit receivable. First reverse this entry. So if you will reverse, the entry will be debit receivables and credit allowance of uncollectible account. And second entry, what you can do, record the cash collection. So normal cash collection, and for that you will pass entry debit cash and credit receivables. So if you want to make one entry, you can see here in this entry your receivable is debit, and the second entry your receivable is credit. So this will be net off. So remaining items will be debit cash account and credit allowance for uncollectible account. This is what is the direct entry is also written here. You can see here debit cash credit allowance of uncollectible account. So again, here they might ask the question here, note at the time of recovery of bad debt, so it has no effect on expenses or income. Okay, so this is really important. Now guys, I'm going to talk about the summary. Okay, I'm just gonna to summarize this topic what we learned here. Actually guys, there's a summary for what? Allowances of uncollectible accounts. Sometime he might give you certain data, and he might ask you, I mean to say examiner might ask you to find out the missing value. So this equation you should remember, guys. Usually we will take opening balance for uncollectible accounts. It is always credit nature, so we will take the opening balance plus bad debts expense for the period, because when you record for the period you record the entry debit bad debts expense credit allowance. So again, allowance is credit, so credit plus credit, that's why it's going to be add here. Okay, so then you have a less account receivables written off. Yes, when you write off the receivables, you passed entry debit allowance credit receivables. So allowance is debit, so that is why it's going to be minus from here. And then you need to plus what? Collection of account receivables previously written off. when you collect it, if you remember direct entry, so what entry we passed, we made debit cash, credit allowance, again allowance is credit, so that is why it's gonna to be add here. Okay, so if you will take this one, opening plus bad debts expense for the period less account receivables written off plus collection of account receivables previously written off is equal to closing balance of allowance. So this is how you will determine the closing balance of the allowance. So here is two notes are there. Please remember, under the income statement approach, bad debts expense is percentage of sale on credit, and the ending balance of allowance is calculated using the equation above. Yes, so this is how you will calculate the ending closing balance of the allowance. Okay, but if you are using balance sheet approach, so the ending balance of allowance is percentage of the ending receivable. Yes, and the bad debts expense is calculated using the above equation. Maybe uh, examiner will give you all closing balance of allowance, collection of previously written off, maybe he will tell you also account receivables written off, opening balance, maybe he will ask you bad debts expense. But you should be aware with the all possibilities. Maybe if there are total, you can see here, five items are there, if any four are given and the fifth is asking, so sometimes you need to reverse the question. When you reverse the question, plus will become minus and minus will become plus. Okay, so for example, in case I'm just highlighting, if you want to calculate bad debts expense for the period, if you want to calculate this, what you will do, you will take closing balance of allowance minus collection of previously receivables written off plus account receivables written off, because you are going reverse now, and this is a plus value, so you will minus now, minus opening balance for uncollectible accounts. This is like a math only, guys. So now here, let me summarize gross receivables also. For the gross receivables, because in balance sheet you need to write gross receivables minus allowances. So how you will get the value of gross receivables? So usually this is what we will take. We will take opening balance of gross receivables plus credit sale less sales return less collection from customer less account receivables written off. So this will give you closing balance of gross receivable. Okay, now guys, if he will give you, for example, all other items, but he's asking for credit sale, now you have to just reverse this equation. Guys, final two notes you should remember: this allowance method, either income statement approach or balance sheet approach, it is allowed, okay, by US GAAP and IFRS also, because actually it follows the matching principles. Okay, but there is another method which is called direct write off method, but this method is not allowed by GAAP or IFRS, but it is allowed only for small businesses. Okay, and what is direct write off method, I will talk about in the next video. I hope guys everything is clear. Thank you so much to everyone. Thanks to everyone. If you really like the video, please don't forget to subscribe to the channel. If you have any question, you can ask me through the comment section. Thank you so much. See you in the next video. Bye bye.